I have learned, through more losing trades than I care to remember, that the market has a way of punishing impatience. Nothing does it more efficiently than a range-bound market. You see a price line press against resistance. It looks eager, almost alive, and you think, this is it. Haven't we all thought that? But when a market has no real trend, when it is simply pacing back and forth like a caged animal, breakouts have a habit of failing, and failing fast. Failed breakouts reveal a lack of strong hands, and that lesson cost me more money than any book ever could. When a breakout fails, it is not because the chart lied to you. The chart told the truth. It showed you who was really in control. The market moved above resistance, yes, but who was buying? Was it the operators with deep pockets and patience, or was it the public chasing a price that already moved? That is the question most traders never ask themselves, isn't it? Strong hands do not rush. They do not chase prices after an obvious level gives way. They prepare long before the breakout ever appears on your screen. When they are active, price does not hesitate. It moves, pulls back lightly, and then moves again. But when a breakout fails, what do you see? Immediate stalling, long wicks, quick reversals. That is weak buying, nervous buying, buying that needs instant confirmation, or it runs for the exit. Weak hands buy because they are afraid of missing out. Strong hands buy because they have already decided. When price breaks out and cannot attract continued demand, it means the strong hands were not interested. The move was fueled by late money, and late money has no loyalty. It sells at the first sign of discomfort. Have you noticed how fast confidence disappears when price slips back into the range? This is where traders misunderstand volume. High volume on a failed breakout often signals distribution, not strength. Shares or contracts are changing hands, but not into conviction. They are being passed from those who prepared to those who react. And once that transfer is complete, price has nowhere to go but back. Understanding this changes how you trade and how you think about money. You stop needing to be right on every move. You stop chasing. You start observing behavior instead of patterns, because the market always shows you whether strong hands are present. You just have to stop arguing with what it's telling you and start listening while everyone else is still buying the breakout that has already begun to fail. A breakout needs conviction, not hope, and hope is the most expensive thing a trader can bring to the market. I have watched men with good charts and bad judgment lose simply because they wanted the market to do something it had not yet decided to do. Hope steps in when facts are missing. Conviction steps in only after facts have shown themselves. Can you tell the difference while the trade is forming, or only after it has failed? Hope buys because price crossed a line. Conviction buys because demand is already present and willing to pay higher prices without hesitation. When a market breaks out on hope, it moves a little, just enough to invite attention, and then it hesitates. That hesitation is the tell. The market pauses because it is asking a question, and the answer is often silence. No new buyers, no urgency, just traders staring at their screens, waiting to be reassured. Conviction shows itself in behavior, not in indicators. Price moves with purpose. Pullbacks are shallow. Time works in your favor instead of against you. When conviction is present, the market does not need encouragement. It does not need headlines or excitement. It already has sponsorship, and when sponsorship exists, price does not rush back into the range the moment it meets resistance. Hope, on the other hand, needs constant confirmation. The hopeful trader checks the chart every minute, wondering if the breakout is still valid. That alone tells you something is wrong. If a trade requires emotional support, it is already on borrowed time. Have you ever noticed how hopeful trades feel heavy almost immediately? This is why patience is a financial skill, not a personality trait. Waiting for conviction keeps you aligned with real money, not emotional money. Wealth in trading is built by participating in moves that do not need persuasion. The market either has strength or it doesn't. And when it doesn't, no amount of hope will give it legs. Most breakout buyers become forced sellers, and that fact explains more failed trades than any indicator ever could. The market has a cruel way of turning optimism into urgency. When traders buy a breakout without preparation, They place themselves in a position where time immediately works against them. If price does not continue higher right away, pressure begins to build. Have you felt that tightening in your chest when a breakout stalls? Breakout buyers often enter with tight stops because they are unsure. They know, even if they won't admit it, that the market may not follow through. When price hesitates, those stops become magnets. A small pullback turns into a wave of selling, not because conditions changed, but because confidence did. The breakout level that looked strong now becomes a line of fear. What follows is predictable. As price slips back into the range, breakout buyers are no longer participants, they are trapped. Their original reason for entering the trade is gone, but their position remains. At that point, selling is no longer a choice, it is a reaction. They sell to escape discomfort, not to make a decision. That is what forced selling looks like. This behavior feeds on itself. One trader exits, pushing price lower, which triggers another exit, and soon the breakout collapses under its own weight. Meanwhile, stronger hands are not panicking. They are watching. They understand that weak buying always creates weak structure. A market built on fear cannot support higher prices. Understanding this changes how you approach risk. You begin to ask where the forced sellers are likely to appear before you ever place a trade. You stop seeing breakouts as invitations and start seeing them as tests. Tests of commitment, of patience, of real demand. Because if a breakout depends on traders who cannot hold, it is already unstable, and the market has a way of finding the weakest point and pressing on it until selling becomes unavoidable. Balance repels price, it doesn't release it, and that is something most traders learn only after being pushed back again and again. In a balanced market, price is not searching for a new level of value. It has already found one. Buyers and sellers are in agreement, even if it doesn't look that way on the surface. Price moves up, it moves down, but it always returns to the same general area. That is balance at work. And when you try to force a breakout in that environment, you are fighting gravity. Have you ever wondered why price seems to reject certain levels no matter how many times they are tested? Balance acts like a cushion. When price moves too far in one direction, the other side steps in, not emotionally, but mechanically. Sellers sell higher because value appears expensive. Buyers buy lower because value appears cheap. Neither side is urgent. That lack of urgency is the key. Without urgency, price has no reason to escape. It can probe the edges of the range, but it cannot leave it behind. A ranging market is not a market with conviction. It is a market in conversation with itself. Prices move up, not because they must, but because they can. Then they move down for the same reason. When you buy a breakout in such conditions, you are not aligning with force, you are arguing with balance. And the market does not reward arguments. Have you noticed how quickly those breakouts reverse, almost as if they were traps set just for the hopeful trader? I used to think activity meant opportunity. That was ignorance talking. In a range, the public is active, but the professionals are patient. They wait. Breakouts fail because there is no fresh money willing to carry price forward. The buying that pushes price above resistance is often the same buying that soon becomes selling. That is not accumulation, that is rotation. And if you do not know the difference, your account will teach you, expensively. This is where money mindset matters. The trader who needs action will always find a reason to trade, even when the market offers none. But the trader who aims to build wealth learns to sit on his hands. Do you really need to be in the market today, or do you just want to feel busy? Capital is not made by excitement. It is made by waiting for conditions that favor follow through. I learned to respect ranges by watching them exhaust traders. False highs, false lows, quick profits that vanish. These are not accidents. They are symptoms. When a real breakout comes, it comes from compression, from quiet, from boredom. Until then, every breakout attempt is suspect, and every position must be small, cautious, almost reluctant. So when price pokes its head above a range and calls your name, the wiser question is not how much can I make, but what kind of market am I in right now? Because the answer to that question decides whether you are trading with the market or merely donating to it. Traders mistake repeated tests of resistance or support as pressure building for a breakout. Often it is the opposite. Each test relieves pressure. Each rejection confirms acceptance. The market is not coiling, it is settling. Balance does not explode, it absorbs, and the more time price spends inside a range, the more comfortable it becomes there. This is why breakouts from balance are so unreliable. The moment price pushes too far, it encounters opposition that is calm and well-funded. That opposition doesn't chase, it waits, and waiting money is powerful money. When price is repelled back into balance, it is not failure, it is function. Understanding this reshapes a trader's mindset. You stop demanding movement and start respecting structure. You recognize that wealth is built by aligning with imbalance, not by attacking equilibrium. Balance is a warning sign, not an opportunity. And until that balance is truly disturbed by new information, new participation, new urgency, price will continue to be pushed back toward the center, no matter how convincing the breakout looks in the moment, no matter how badly traders want it to be the start of something bigger. Ranges exist to exhaust emotional traders, and the market is very efficient at doing exactly that. A ranging market does not attack you all at once. It wears you down slowly. One small win here, one small loss there. Just enough movement to keep you engaged, but never enough to reward conviction. That constant back and forth drains confidence. Have you noticed how a range feels busier than a trend, even though it goes nowhere? Emotional traders struggle in ranges because ranges offer uncertainty without resolution. Every move looks important, and none of them are. Breakouts appear, fail, then appear again. Each attempt invites hope, and each failure chips away at discipline. The trader begins to trade more often, not less. He sizes up to recover losses, or sizes down out of fear, but in both cases he is reacting instead of planning. The market knows this behavior well. Ranges are not random pauses. They are environments where weak hands reveal themselves. The longer price stays confined, the more impatient traders become. They start anticipating moves instead of waiting for confirmation. They take signals that are not quite there. They convince themselves that this time is different. Isn't that the most dangerous thought a trader can have? Meanwhile, patient traders are not exhausted. They are preserved. They understand that capital and emotional energy are connected. Every unnecessary trade drains both. By doing nothing, they maintain clarity. They observe which side is becoming more frustrated, which moves are attracting the most emotional participation. This is how ranges prepare the next real move. Not by building pressure in price, but by redistributing risk from the patient to the impatient. By the time the range finally breaks, many emotional traders are already wounded or sidelined. Their accounts are lighter, their confidence shaken. The market has accomplished its work without ever trending, without ever offering a clean opportunity, simply by allowing time to do what volatility could not, steadily wearing down those who could not accept that waiting is part of the business. Capital is preserved by waiting, not trading, and that truth runs against every instinct the average trader brings to the market. Most people believe money is made by activity, by constant participation, by always having a position on. The market quietly teaches the opposite lesson. It rewards those who know when not to act. Have you ever noticed how your worst losses come from trades you didn't need to take? Waiting is not passive. It is an active decision to protect capital until conditions justify risk. Every time you avoid a low-quality setup, you earn something even though no profit shows on the screen. You preserve buying power. You preserve emotional balance. Those two things matter more than any single trade. A trader without capital cannot act, and a trader without clarity cannot think. In ranging markets especially, trading too much is a form of self-sabotage. The market offers movement, but not opportunity. Each trade taken without edge is a small leak in the account. One leak doesn't sink the ship, but enough of them will. The professional understands this and accepts boredom as part of the job. The amateur fights boredom and pays for it. Waiting also sharpens judgment. When you are not in a trade, you can see structure clearly. You are not defending a position or hoping for a result. You are observing behavior. You notice how price reacts, not how you want it to react. That distance is valuable. It keeps you aligned with reality instead of expectation. Wealth in trading is not built by constant engagement. It is built by selective engagement, by risking capital only when the market shows its hand, by staying out when conditions are unclear. The trader who survives long enough to grow wealthy is not the one who traded the most, but the one who lost the least during periods that offered nothing worth taking, who understood that standing aside is also a position, and sometimes it is the only position that makes financial sense. False strength is common inside congestion, and it is one of the easiest illusions for a trader to believe. In a tight range, price can rise sharply for a short time and look powerful, almost convincing. Candles expand, volume increases, and suddenly the move feels important. But strength without continuation is not strength at all. It is motion without intent. Have you ever chased a move that looked strong, only to watch it fade almost immediately? Inside congestion, price moves are often reactions, not decisions. A push upward may simply be short covering, or late buyers reacting to what they see instead of what they understand. That kind of buying has no patience. It needs immediate reward. When that reward doesn't arrive, the strength evaporates. The market drifts back to where it started, and the illusion is exposed. True strength behaves differently. It does not need to announce itself loudly. It holds ground. When price is strong, it stays near the highs. It does not rush back into the range the moment pressure appears. False strength cannot do that. It collapses under the smallest test because it was never supported by committed money. Congestion is where traders confuse volatility with direction. They see expansion and assume progress, but expansion inside balance often serves the opposite purpose. It attracts attention, draws in emotional traders, and provides liquidity for those who are not interested in higher prices. The market uses false strength as bait. This is why patience protects capital. A trader who waits to see whether strength can sustain itself avoids most of these traps. He watches how price behaves after the move, not during it. He understands that the market reveals its intentions through what it refuses to give back. Without that understanding, traders end up buying enthusiasm and selling disappointment, repeating the cycle again and again, slowly bleeding capital while convincing themselves they are just early, unaware that congestion exists precisely to reward that kind of misunderstanding. The market advertises traps before trends, and it does so in plain sight. Most traders miss them because they are focused on outcomes instead of behavior. Before a real move begins, the market tests participation. It shows you what looks like opportunity, then watches who takes it. Have you noticed how the most obvious setups often fail just before a meaningful trend starts? These traps are not accidents. They are part of the process. A market cannot trend until weak positions are cleared out. False breakouts, quick reversals, and sharp rejections serve that purpose. They lure in traders who act on anticipation rather than confirmation. When those traders are forced out, the market becomes cleaner, lighter, more capable of sustained movement. Traps work because they look logical. The chart lines up. The pattern is familiar. The story makes sense. That is why so many fall for it. But logic without context is dangerous. In a ranging or transitional market, the first move is often the wrong move. It is designed to attract attention, not reward it. Experienced traders learn to watch reactions instead of entries. They study what happens after the breakout, not the breakout itself. Does price hold? Does it invite new participation? Or does it snap back as soon as buying pressure pauses? The answer tells you whether the market is preparing for a trend or simply setting a snare. Understanding this changes your relationship with patience. You stop trying to catch the first move. You accept that missing the beginning is not failure, but protection. Wealth is built by participating in moves that have already proven themselves, not by guessing which attempt will finally work. The market always signals its intentions, but it speaks through behavior, not promises, and until you learn to read those signals, the traps will always feel like bad luck instead of what they really are, deliberate tests that separate traders who react from those who wait. Small positions are survival tools in ranges, not signs of hesitation or fear. When the market is moving sideways, uncertainty is not a flaw in your analysis, it is a condition of the environment. Trading large in that environment is not confidence, it is denial. Have you ever noticed how calm you feel when your position size is small, and how noisy your mind becomes when it's too big? Ranges distort feedback. A good entry can still fail, and a poor entry can still make money for a moment. That randomness makes size dangerous. When outcomes are inconsistent, exposure must be controlled. Small positions allow you to stay engaged without being emotionally compromised. They let you observe the market without needing it to behave a certain way. In a range, the goal is not to extract large profits. The goal is to protect capital and information. Every trade is a probe, not a commitment. You are testing behavior, not forecasting direction. Large size turns a probe into a bet, and bets belong in markets with clear imbalance, not in environments defined by equilibrium. Small positions also protect decision-making. When risk is contained, you can exit without hesitation. You are not negotiating with yourself. You are not hoping for a bounce just to avoid a loss. That clarity is invaluable. It keeps you aligned with price instead of emotion. Many traders think scaling down means missing opportunity. In reality, it preserves opportunity. Capital that is protected remains available when conditions finally change. Wealth in trading is built by surviving long enough to participate when the odds shift decisively. Small positions are how you stay in the game during periods that offer more noise than opportunity, more temptation than edge, allowing patience to outlast frustration while the market decides what it wants to do next. Professionals wait while amateurs chase, and that difference explains why most accounts fade while a few endure. Waiting looks easy from the outside, but it is one of the hardest skills in trading. The amateur feels a constant pull to act. Every price movement feels like an invitation. The professional feels no such pressure. He knows the market will be open tomorrow, and the day after that. Have you ever asked yourself why you feel rushed when the market itself is in no hurry? Chasing comes from insecurity. The amateur believes opportunity is scarce, so he grabs at every move. He buys late, sells early, and repeats the cycle. The professional understands that real opportunity is rare, and that most movement is just noise. He lets price come to him. He does not pursue it across the chart. This difference shows most clearly in ranging markets. Amateurs buy the highs and sell the lows, reacting to emotion. Professionals observe where others are becoming impatient. They see failed breakouts not as frustration, but as information. They recognize that the crowd is revealing its weakness. Waiting also shapes mindset. The professional measures success by discipline, not by trades taken. He is comfortable doing nothing, because he knows that restraint is part of execution. The amateur equates action with progress and silence with failure. That belief quietly drains his account. In the long run, wealth follows behavior. The trader who waits avoids the traps set for the impatient. He keeps his capital intact while others give theirs away in small, repeated losses. By the time a real move develops, the amateurs are exhausted, emotionally and financially, while the professional is still fresh, focused and ready, having spent the quiet periods watching, learning, and letting the market come to him instead of chasing every move that briefly looks like opportunity. Compression matters more than excitement, and most traders confuse the two. Excitement is loud. It shows up as fast candles, sudden volume, and urgent commentary. Compression is quiet. It looks dull. Price barely moves. Time stretches. Nothing seems to be happening. That boredom pushes traders away, and that is exactly why compression is important. Have you noticed how the market often feels most uninteresting right before something meaningful happens? Excitement usually appears late. It arrives after price has already moved. By the time traders feel energized, the opportunity has often passed or become unstable. Compression, on the other hand, is preparation. It is where positions are built carefully, without urgency. Strong hands do not need movement to accumulate. They need time and liquidity. In ranging markets, excitement is often a trap. Sudden spikes lure in emotional traders who believe momentum has arrived. But without compression, there is no foundation. Price has nothing to push against. Those moves fade because they are reactions, not releases. Compression creates pressure not by force, but by restraint. Learning to value compression changes how you read charts. You stop chasing candles and start observing time. You pay attention to how long price stays contained, how volatility contracts, how reactions become smaller. Those are signs of energy being stored, not wasted. This also shapes patience. Waiting through compression feels uncomfortable because there is no immediate feedback. But that discomfort is a filter. It keeps impulsive traders out. Wealth in trading comes from enduring that quiet phase without forcing action. When compression finally resolves, it does so decisively, because the market has prepared itself. Without that preparation, excitement is just noise, and noise does not sustain trends. It only creates motion that quickly burns itself out while leaving traders exhausted and confused, wondering why the move they chased had no strength behind it. Repeated failures signal structural balance, not bad luck, and that is a distinction most traders are slow to make. When the market tries again and again to move in one direction and keeps getting pushed back, it is sending a message. The message is not that you entered poorly. The message is that the environment is wrong. Have you ever blamed yourself for a trade when the market itself was simply unwilling to move? In a balanced structure, every attempt higher finds willing sellers, and every attempt lower finds willing buyers. This creates the illusion of opportunity on both sides, but delivers follow-through on neither. Traders see these repeated failures and assume pressure is building. They think each attempt weakens resistance or support. Often it strengthens it. Each failure confirms acceptance, not exhaustion. Markets in balance are efficient at absorbing effort. They take in buying and selling without shifting value. That is why repeated breakouts fail. They are not close calls. They are tests that have already been answered. The structure holds because neither side is dominant. Understanding this prevents overtrading. You stop treating every failure as a personal mistake and start recognizing patterns of rejection as environmental signals. You adjust size, expectations, and frequency. You trade less, not more. This also reframes patience. Waiting is no longer about discipline alone, but about alignment. You are waiting for imbalance, for asymmetry, for evidence that one side is finally overwhelming the other. Until that happens, repeated failures are not invitations to try harder. They are warnings to step back. Wealth is protected by listening to those warnings instead of arguing with them, by accepting that some markets are designed to go nowhere for long periods, and that survival during those periods is not passive, but intentional. Informed restraint that allows you to stay objective while others exhaust themselves fighting a structure that has no intention of breaking yet.